Hello, friends. Welcome to the Weekend Investing Daily Bite of 7th of February. So, we had a RBI meet today, the outcome of the board meet, and we had a quarter percent rate cut. Repo rate has been cut. The market was kind of expecting it. There hasn't been any major reaction to it. Um, the conventional thought process is that rates are getting cut, and hence, industry will benefit, credit cycle will take off, home loans will take off. But somehow, everything gets discounted ahead, and on the day of the news, there's not much that is happening. Um, so that's on the RBI front. Today in the video, second half of the video, we will take up round 33 of Ask Weekend Investing questions. So we have been accumulating questions since yesterday for people to ask, and we will be answering those in the second half. Do read the disclaimer, and of course, do subscribe to the channel as well. Where is the market headed? Very nice drop in Nifty, but then a pullback also. Um, and 0.18% loss on Nifty is no big deal. So I think the market is still hanging on to that gain that we saw 3 days back. So this jump and this gap that was created is still not filled. And that is good news that despite some weakness, the market has not gone and filled this gap. It shows that there is some undercurrent strength yet in the market. But once it does go and fill that gap and breaks this pivot here, then you may say that the market is really getting weak again. But till then, I think we can live with the hope that the market is looking reasonably steady. Nifty Junior absolutely flat, had gone down, but recovered most of it, plus 0.02%. Mid caps very flat, doji candle on mid caps, so that kind of nullifies the move that started yesterday, 0.13%. On the small caps, small move down, some gap filling there, minus 0.39% on small caps. No harm done in my view. Bank Nifty down almost 0.44%. But then again, we are still higher than where we were when this big move came 3 days back. So overall, I'm not at all worried about the markets. Gold down by 0.23%, although on the chart it looks like up. I maybe this it's plus 0.23%. I'm sorry about that. And in terms of momentum trends for gain advances and declines, you had 185 advances to 313 declines. So the broader market is slipping, and that is a sign of some worry for sure. You had some pockets of green today. So ITC major losing 2.32% after the results, despite a very healthy 6.5 rupee dividend announced. ONGC also lost 2.83%. Reliance losing 1%. State Bank losing another 2%. TCS 1.3%. ICICI Bank 1.2%. Bharti Airtel, after its numbers really flying off. Minerals and the metals space, along with cement space, really doing well. So that is flying. You had Tata Chemicals, JSW Steel, Hindalco, Ultrasemco all doing well, and some recovery in trend today at 3.3%. But that was the picture on the Nifty. On the Nifty Next 50, you have Lodha doing well, Zomato, Torrent Pharma, Shree Cement, JSPL, and Vedanta, which were leading the pack. Gas Authority lost a lot of money, 4% today. Varun Beverages, Naukri, Siemens, Bank of Baroda, LIC, these were some of the other losers. Sectoral trends, not really much to talk about. PSU banks and FMCG ruled the downward side, along with oil and gas and CPSEs. So the weakness was largely in that space. And metals were standing out completely, 2.7%, wiping out all the losses for this week and for the month for this particular segment. So metals really leading the markets today. So there is a sector rotation that is happening from time to time. Today it was the day of the metals. FMCG is a worrying factor because all top FMCG companies have come out and the results seem to be reasonably decent, but somehow, uh, from what I hear from fundamentalists, they are still very, very expensive. So in the last 1 year has gone with FMCG posting virtually 1% gain, which is of course better than energy stocks, better than oil and gas, but at least those sectors had performed in the previous 2 3 years. FMCG, I don't know since when it has not performed. So there is some worry on FMCG front for sure. Metals doing very well today, 2.6%, and this is the list of the metal stocks that did very well today. Welspun, Jindal Steel and Power, Tata Steel, JSW Steel, all the big ones did quite well. Let's get into the meat of the video, the Ask Weekend Investing round 33. We've answered 610 queries in the previous 32 rounds. All the videos are available. You can check the description for links, and you can go into one by one. And once you go through several of them, I think all your queries about small small case investing, momentum investing, any specific queries about weekend investing probably will get solved, because so many queries have been solved, and that probably would have covered a lot of ground. And it's a great knowledge database. I mean, just going through that will just educate you on many things that you may probably have been missing. Uh, Raja Babu says, please design an absolute strategy where in downturn amount is invested in gold instead of cash. My friend designed a strategy like this and he's getting better results. So right now, gold is doing well. So, gold instead of cash probably is doing well. But the idea of going to cash is to, you know, is very specific one. In a strategy where stocks are getting liquidated and amount goes to cash or to gold will also work well, but it requires a deeper study to see, in periods when we go to absolute cash, which is probably very near the bottom of the market. At that point of time, what has been the performance of gold? Overall, of course, one can say that when markets are going down, gold is doing well. So that by design can be a good strategy. We'll need to deep dive into this and see if we can come up with a new strategy of that. Manish says in momentum portfolio, some stock goes down with 30% before rebalance day. What do we do? Big or wait for rebalance day? So we will, since February of 2022, we have introduced mid-period rebalances where if we find any particular stock is uh, exceeding the mid-period rules that we've set, then we will issue a mid-period rebalance and uh, take that stock out. For instance, on Thursday, we've issued a mid-month rebalance on two monthly strategies, MI Top 10 and MI Evergreen, and one stock has got changed. So this is already in place. Renault says how young investors should handle volatility. It's difficult said than done, while a major chunk of portfolio is losing every trading day. So I think young investors should actually be looking at the markets in a very long-term manner. Why are you even worried? I mean, if you have a runway of 40 years ahead of you, what is the worth of 4 months of volatility in that? Nothing I believe. I mean, why do you think the great of greats have made money in the markets over a long period? Because they were able to, look for a longer period of returns than get worried on a day-to-day basis. So stop looking at your portfolio on day-to-day basis and trying to, basically come up with solutions on how to reduce your loss. If you're following a strategy, let's say you're following a momentum strategy at Weekend Investing, then at least for a week or a month, you know that you're not going to do any rebalance unless there is a mid-period rebalance. So during that period, all that is noise. Then whatever is happening during the day is also noise. So anybody who's doing rebalance Monday to Monday ideally should not be looking at the market at all. Okay, once in a while, you'll take a peek at the market just for your interest sake, but don't get worried about stocks moving up and down, because if you're not taking action at that moment, then what is the whole point of seeing that volatility and make your heartbeat go up and down? So it's best to approach it in a very military-like fashion. I know my exits, I know my entry points, I know my rule book, or I'm following somebody who knows his rule book, and just execute. Uh, Assume that you have put your money to, let's say, to a mutual fund. Are you watching those stocks? You don't even know what stocks they hold for you. You're just watching the base NAV, which also most people don't watch on a day-to-day basis. But just losing that short-term focus, I think, helps a lot of folks. Yogin Shah says, can we have only mid and small cap stocks in portfolio and completely avoid large cap stocks if time horizon is 10, 15 years? Yes, of course you can do that. There are many people who will do only small caps. There are many people who will do only mid caps. Uh, so I mean, there's nothing. I mean, all categories of the market will make money. It's just that the risk profile may be a bit different for each category, and the lumpiness may come at different times. So yeah, I mean, you could do that completely. Rajan says how your momentum strategy handles volatility, as volatility can often create false alarms to show stock in and out of momentum. Yes, that can happen. I mean, we have two ways in which momentum strategies are running. One is the absolute momentum way, where if there is considerable uh, drawdowns in any stocks, then the strategy goes to cash. If there is no available stock which is having high momentum, then the money will stay in cash till such time the market starts to go up. In the other one, where if we are looking at rotational momentum, this the strategy remains invested just like an index. So you are running an index, and along with the market, you are trying to rotate into the stronger stocks. As the market comes down and as the market goes up, you will get into the new sectors of stocks that will take the lead in the next bull run. That's how we basically handle volatility. Another question from Yogin Shah: how does momentum strategy work in bear market? As I've heard, it works only in bull market. No, so this is basically just a way of rubbishing some style of investing. What works in bear markets? Every stock goes down, right? So if it's a long only strategy, then obviously it will come down. But here, the chance is that you will rotate into those stocks that will lead the next rally. So yes, when the first wave of the bear market strikes, likely that momentum stocks will fall more. Momentum strategy stocks. There is no concept of momentum stocks, but there is a concept of stocks which were in high momentum at that point of time, because people rush to sell those stocks where they have the most profits. So they will fall more in the first leg down, and then in the next leg down, either you will be moving to cash and the market will keep bleeding, or you will move to stronger stocks and the weaker stocks will keep bleeding. So that's the whole idea of how the momentum strategy is likely to approach in a bear market. But what I mean, there is studies of hundreds of years of data to rubbish all these memes that are made about momentum strategies. Go read that. Go read the academic papers which tell you that there is no better way to invest in the markets than momentum. I mean, what bigger claim can one make if academia has proved this? So I'll leave it at that. A student at market says, which basic filters do you use before selecting stocks for momentum investing strategy? So we use volume filters. We use regulatory red flag. There should not be any red flags of any regulatory kind. It depends. I mean, the ASM, GSM categories, if they are applied while the stock is already with us, we probably will not get out. But if there is some a red flag by SEBI or red flag by exchange regarding promoter quality and all that, then of course we will not be touching that. So I hope that question is done. Uh, Money Wale Sardarji says, with SGB new issues gone away, what would be the best way to add gold to existing portfolio of SGBs? Is ETF, SGB from market, or mutual fund gold unit? The option that is not there in your question is physical gold. That remains the most pristine way of investing in gold. Yes, it has its own issues. The cost is more, the storage cost is more. There is friction of selling. All that is there, but that is why it is pristine. And the next best, of course, is paper gold, which is ETF or secondary SGBs or mutual gold funds or digital funds, etc., etc. Within this category, I like the most is ETFs. Indian ETF uh, rules for gold are reasonably stringent. Just today, I have talked to two gold fund managers wanting to know whether they are lending out their gold, etc., because there is reasonable concerns in the global market regarding ETF lending, and they have assured me that there is no virtually no lending market in Indian ETFs. And two of the big AMCs have assured that they have nothing lent out. So ETFs probably is my second bet, unless you can get SGBs at a fair or a cheap valuation in the secondary market trading. Ahmad Zishan says, in your videos, you talk about investing based on 1 year momentum. Is there any study that supports this time frame? I have never talked about 1 year momentum being a go-to time period. That is may have been an illustration that I've given. I certainly don't say that just look at 1 year momentum and make your decisions. In absolute momentum Deepak is saying in absolute momentum strategies, will it be advisable to shift to gold Bs in place of liquid Bs? Any thoughts on this impact? This is a repeat of the question in the beginning, so I think one can go and look at that question. But the answer is that uh, I don't have a ready study done on this, how beneficial it can be to go to gold. Uh, Ravi says, why are SGB prices discounted or nearer to gold spot prices these days, which are supposed to be at premium? Is this the effect of new tranches discontinuation? Do you recommend purchasing gold SGBs now from secondary market? If you are getting it at a discount, I think SGBs still have a lot of value. Um, there will be, of course, phases in this journey where paper gold. SGB is also like a paper gold. It is a high quality paper gold, but it is paper gold. Where the gold is promised by somebody that if you will achieve the till maturity date, then the gold price will be given to you. The gold will not come to you. So to that extent, it does not have the pristine quality of the physical gold, but the next best possible is there because the sovereign government is backing this. Uh, so whenever you find SGBs at a discount, I think that is a reasonable place to get in. There is one very nice utility by Mr. Amit Wani on SGBs where it will calculate the existing discount and premium, etc. Please use that. Uh, we have done several videos on that also. If you do a search, you'll find it. So if you find it at discount, why not? Funny says, I have invested in two small cases. One of them is defense, and one of them other is energy. So these are not weekend investing strategies. Let me just make clear for others because we don't do sector specific um, small cases. It goes on to say both are down by substantial percentage. Should I exit and book losses now, add capital to evergreen, or wait for recovery? I will not be able to give any advice on this because I have no clue uh, how that manager is likely to make or churn their portfolios, what is their strategy, and it will be unfair to comment on anybody else's strategy. In my view, before you enter into any thematic portfolios, do keep a stop loss in mind that if this theme doesn't work for me, I'll get out because that that theme, if it's a pure, let's say it's a pure defense small case, then it will have to remain invested in defense even if defense goes another 50% down. That is the problem with thematic cases. So this is something that I cannot give advice also on a from a license perspective. Sarita says, who can or should opt for AIF, and please help us understand it better. So AIF is basically a vehicle for investments, just like a mutual fund or a portfolio management service, where you basically give your money to that vehicle manager and to that vehicle, and there's a manager there who will manage it. So you will basically not be doing anything. You will only be putting your money with the manager, and the manager will manage it. So from versus the existing strategies where your money doesn't come. For instance, for weekend investing, your money is never touched by us. It remains with you in your demat account. We don't even know what you're buying or selling in your demat account. So it is a completely hands-off kind of a situation where only the model portfolio from us goes to the platform and the platform sends it to you and you do a click of a button and you execute it at your end. That's all. So, there's a full sort of Chinese wall between the advisor and the client. In a AIF slash PMS slash mutual fund operation, you basically give your funds to the manager or the AMC. Or the PMS or the AIF, and they will manage it, and you can withdraw it basis the terms. If it's an open-ended scheme, you can withdraw it anytime. If it's a closed-ended, you'll have to pass that much time. So AIF is typically for larger investments, 1 crore and above. PMS is usually for 50 lakhs and above, and mutual fund, of course, is 500 rupees and above. And now they're making it 250 also. So that's the sort of larger, bigger picture for AIF. I hope. Supriyo says, any plan for launching something under new asset class by SEBI? I forgot the name. Not sure if it's something like mini PMS. So this new asset class by SEBI is actually a a scheme by SEBI for the asset management companies to have a new product, which is minimum of, let's say, 10 lakh rupees. So only asset management companies can launch that. So Weekend Investing is not an asset management company, and so we cannot launch it. But yes, we are thinking of launching an AIF in 2025. Sneh Gupta says there is significant correlation between US market and gold returns. Whenever yield increases, goes down. How can we then consider it as a hedge? So sad my question is not covered. We are covering your question, right? So don't worry about that. The correlation of gold is with US market may be a significant correlation. So the fact remains that gold is an antidote of the dollar, right? So you have to see it from that point of view. If your assets are already in US dollar denomination, then probably you don't need gold, or you don't need gold as much, as much as a, let's say, I am fully invested in INR assets, whether it is real estate, whether it is stocks, whether it is anything else that I have, except maybe some US stocks if I had them. So my exposure is completely INR. And let's say, INR goes for a toss, and we have a government which destroys whatever has been built, then I have no place to go, right? So I need an asset class where it is not dependent upon INR returns. It is dependent upon a USD based pricing of that asset. And yes, after conversion in INR, I'll get whatever I'll get. Right. So that becomes a big hedge for me as a country risk, currency risk, and of course, it has a very good negative correlation with Indian markets also. So gold may not be such a great asset for a US dollar based investor. But if you see the last many decades of data, gold has given about double-digit returns, 9.5%, if I'm not mistaken, in USD. Uh, so returns have been great even in the USD terms, but of course the correlation is better with emerging markets. Um, if we have sort of not taken up your query, I'm sorry, but we may have missed it, or we've run out of time, I guess. So ask Weekend Investing will do this every Friday, so you can take up the comment next week, or if it's a very burning query that requires immediate answering, please drop us an email, and we will certainly try to answer that. So that's all we have for this time. All the previous episodes are here in the description. If you want to go through them, that will be a great learning for everybody. Thank you so much for watching. Do like and share these videos if you like them, and do subscribe to the channel. Thanks. Bye.